The solid gains of recent years seem to be dissipating. The IMF says economic activity in Sub Saharan Africa is contracting fast and is impacting growth.
We think despite the fact that Sub-Saharan Africa has made progress in increasing its revenue to GDP ratio in the last decade or so, considerable progress, there is still potential there that countries can reap by really looking at some low-hanging fruits in terms of better compliance and looking at how they better manage their natural resource wealth. And there's some issues there on the tax policy side that some countries need to look at.
A slowing global economy and weak Chinese growth in particular have put a strain on most African economies that have over the years become heavily dependent on commodity exports. Slowing demand is driving up fiscal deficits and high debt levels, a situation that the IMF is warning against.
Countries are trying to adjust, some of them, and certainly we're giving advice accordingly that even for those countries that are benefiting from the reduced oil prices because they're net importers of oil, they are facing shocks from their other commodities, and they certainly need to manage and to adjust to those shocks.
Oil exporting countries such as Nigeria and Angola have been hard hit as oil prices more than halved in the last year.
They have to quickly look at their fiscal positions, look at how they can generate more non-oil revenues, for example, because some countries are very dependent on oil revenues and now they have reduced amounts. Look at expenditures more closely and to make sure that the limited envelopes they have are now devoted to the highest return investments.
Growth on the continent is still expected to grow more than most other regions, but with very few countries having buffers or substantial reserves for times of crisis, Africa may be in for more shocks. It's going to be tougher for those African countries that have received funding from the IMF to meet growth targets. Sumitra Nydoo, CCTV, Johannesburg.